The market sell-off resumes as higher U.S. tariffs kick in, including 104% on China, but there's no immediate retaliation from Beijing. The Spanish Prime Minister calls for the EU to review its relationship with China in light of the trade war. He's set to meet the Chinese president on Friday. Plus, yields on 10- and 30-year Treasuries soar, threatening the status or the asset status as a haven. So let's get straight to the markets. I warn you, it's going to be a big market day just to try and understand exactly some of the reaction function from some of the Treasuries. Now, we look at FX. I need to tell you a couple of things in terms of what we're seeing. For example, European stocks opening lower following declines, of course, in Asia. It's extremely clear that the fact that they're taking place today, the tariffs, is doing something also to Treasury. So we'll really zoom in and have a look at that. It's also impacting or infecting which way you want to see it. For example, the UK 30-year yield at 5.482. So cross asset, let's have a deep look about this kind of vicious sell-off that we're seeing in what's supposed to be one of the safest assets in the world. Again, investors grasping for reasons behind some of the steep declines in Treasuries. U.S. government bonds, we all know, traditionally a primary haven in turmoil times. Maybe there's a worry about stagflation, that the Fed cannot cut rates as fast as certain participants in the markets expect. S&P futures getting some 0.3%. They've been fluctuating quite a lot in the last hour or so. The 10-year yield at 4.3548. And then finally, look, the European markets map. If you look at Europe, it's really following what we're seeing in Asia and what we saw yesterday in the U.S. A whole lot of red on your screen. The DAX down some 1.8%. Similar losses for the FTSE and the CAC 40. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump's so-called reciprocal tariffs are now in place, dealing a thunderous blow to the world economy as he pushes forward efforts to drastically reorder global trade. Now, China is yet to retaliate to the latest levies, which Washington's tax on Beijing's imports to 104%. This, as President Trump says, there are more tariffs to come.
We're going to tariff our pharmaceuticals, and once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals.
Let's bring in Brendan Murray, who leads Bloomberg's trade and supply chain coverage, and Grace Peters, global head of investment strategy at JP Morgan Private Bank. So thank you both, as always, for joining us. Grace, I guess when you look at Treasuries, what's happening with Treasuries right now? What are the concerns?
I think there's a few concerns brewing underneath the surface. I mean, obviously, with all the tariffs kicking in today, fears about growth, downside risks to growth continue to grow, and we know that a recession doesn't shrink the deficit. So I think that's one thing that the market's concerned about. The other thing that I'd say is this risk premium that's increasingly being attached to U.S. assets. And obviously we had a Treasury auction yesterday. There's another one coming up today. Signs that perhaps demand is a little bit weaker. And all of that is resulting in this steepening of the curve that we've seen, particularly at the 10 and the 30-year point, whereas the front end is slightly more anchored, I think, around some of the nearer term dynamics. But indicative of growing degrees of stress and concern, you know, on a cross-asset basis, and that is flowing through into some of the equity price action that we saw as well.
Yeah, and I guess, Grace, you know, the real worry is that the plumbing doesn't hold up.
I think so. You know, at the moment, a lot of the sell-off that we've seen across markets has been reasonably orderly. And we would say if we had to characterise, you know, we're hovering in the S&P around a bear market territory. If we had to characterise, you know, the anatomy of bear markets, we'd put this down initially as a shock. Right. But obviously shocks, and depending on how long they stay around, can manifest into something more systemic. And so when we think, you know, your question around the plumbing, that does need to hold in order for, you know, markets to remain reasonably orderly, whilst obviously the moves have been significant.
Because there just seems to be a lot of volatility and a lot of stress out there, right? So you don't 100% know where it adds up. Like, if you take lessons from the past, what ends the sell-off?
Exactly. I mean, the range of outcomes is so broad. And so on one hand, you could quite easily say if we kept this effective tariff rate of around 25%, you could quite easily mathematically see US GDP fall to -1%, perhaps even more than that if you take on some of the sentiment channels as well. That could easily wipe $50 off S&P earnings and see the S&P fall below 4,500. On the other hand, I think the market is desperate also for some good news, and we can see how quickly that snaps back. So you can quite easily build a case where the S&P still ends the year at around 6,000. So I think there's an element of using historical data, and that would actually tell us that this is not a bad time to start nibbling at the markets. When you've seen a 20% drawdown on a one-year forward basis, you've got around an 80% chance using historic data that the market's up. On a three-year forward basis, it's almost 100%, even in some really, sort of deep shocks that the market's seen. So historic data is helpful, but there's no doubt that there is more happening below the surface, particularly around how investors are viewing, US assets, the intentional and unintentional drift that we've seen towards US assets over the last couple of decades. And so that is most definitely at play here.
Brendan, as our tariff guy, there doesn't seem to be any, idea of backing down from the White House, or is there that we're just not hearing about it?
Yeah, I think that's the big question is will the White House listen to this kind of analysis and say, maybe we bit off more than we can chew here. The big question coming up for today is how strongly China will hit back. They have been quiet as of now, but they have a tendency to come with their retaliation right before U.S. financial markets open for maximum impact. The range of things that they could hit extend well beyond American imports. They could go after American companies. They could put export controls on key inputs to U.S. products. So it's yet to be seen whether Liberation Day from last week turns into Retaliation Day today. But I think that will set the tone as to whether we're headed toward talks or we're headed toward an extended trade war.
Yeah, and Brendan, this is what Donald Trump had to say yesterday about the tariffs.
And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say.
Again, it's quite difficult to see whether he's willing to take the pain short term, no matter what cost, because he really thinks that this, at the end of the day, in a couple of years, will benefit the U.S. or whether this is a mistake.
Exactly, and let's not forget that the European Union is meeting today. Those trade officials are about to come out with their retaliation for the steel and aluminum tariffs from a couple of weeks ago. Yeah. So we could have 10, 20, $30 billion worth of American products that have EU tariffs on them. How would Trump respond to that retaliation? Would he take the European Union tariff from 20% and put it up even higher like he did with China? So I think we're in a situation now where things could spiral out of control relatively quickly unless cooler heads come to the forefront and say, look, the damage is too great already, and we need to rethink how we're executing these tariffs.
And Grace, we keep on saying, for the moment, China is speaking strong words, but they're actually trying to use, cool heads. We just have a piece of news out of Reuters, which basically says China PBOC has asked state lenders to cut their dollar purchases. I mean, could it be wider than we're expecting? This is not tariffs, but it's actually going after the dollar.
I think there is an element of that which I'd put into the comment earlier about the premium being attached to U.S. risk assets. I think if anything is going to widen, when we think about how that manifests in the client conversations that we're having at the moment, typically that falls into three categories. We've got clients who are looking to defend, we're looking to diversify, and there is some instances where we're looking to dip in because of some of that historic analysis and where markets have got to so quickly. In the defending camp, I think fixed income really comes in, to our conversation earlier around the steepening of the curve. We want to keep it short dated, but you can still get good yields, 6%, if you're thinking about, say 4 years of duration. Structured notes is also really important because in that way you can reduce the directionality of your bet and build in downside protection. Gold, we've spoken a lot about in the last year, Francine. Francine, but gold and hedge funds also really important. And as I say, there are elements you might want to dip in as well. But I think in the dipping in, back to the question about, dollar diversification, I think that's where, people are looking to reduce those overweights and diversify currency as well as equity market exposure.
And Brendan, I ask you this every day, but actually we haven't really got a firm answer on who Donald Trump listens to. I know yesterday there was a very public spat between Elon Musk and Peter Navarro. At the end of the day, it seems that the White House is really split when you look at the impact on the economy.
Yeah, exactly. So the 104% tariffs on Chinese imports is really Peter Navarro's dream scenario. He would probably even go bigger. Elon Musk, on the other hand, has a couple $1 billion invested in a gigafactory in China. So he's looking at the impact, the blowback that could come his way by this. So you have this tug of war going on, the ideology of should we really go all out against China in this trade war, or should we be more strategic about it and try to get to a deal rather than try to blow the whole relationship up.
Yeah, and again, I mean, we talked, Grace, about the impact of the Fed. I think Larry Fink said by certain measures the U.S. economy is already in a recession. And then yesterday we also spoke to Larry Summers. This is what he had to say.
I think it's more likely than not that we're going to have a recession. We're very likely, in the context of a recession, to see markets reach levels significantly below their current levels. So I think we could be looking for fairly serious economic problems.
Is the market too optimistic about how many cuts the Fed can do?
Yeah, I mean, I would agree with the comments that the market can go lower if we're in a recessionary environment. And then I think if we are in that environment, probably the Fed would have to cut more. I mean, the Fed is not going to respond to a market down 15 or 20%. It's going to respond to the data, particularly the data around the labour market. But we're already seeing small signs, that unemployment is increasing. And I think whether it's May or June, that the Fed will absolutely respond to the data. So there's a degree of the Fed put being there, but I think whilst the market is very focused now on downside risks to growth, we shouldn't get complacent still about upside risks to inflation, particularly as we think about, retaliatory action as well.
Brendan, when you look at the timeline for tariffs, and there's a lot to keep up with, I think May 2nd is also when consumers will be taxed if they buy from, mainland and Hong Kong, the kind of the consumer goods that you buy, right, the cheaper things. Does that make a difference to Trump's thinking?
Yeah, I think it all makes a difference. The situation, I think you're referring to the de minimis exemption.
Yes.
Yeah, of course, Americans have gotten very used to buying cheap goods from China, and that loophole is closing as well. So those goods are going to have to find a way. They're going to migrate to other markets, but the demand for sure is going to be curtailed to some extent just by the sheer uncertainty that the economy is undergoing. Businesses now have to say, is this a long-term thing or a short-term thing? Should I just stop ordering and see how this plays out? So that cloud weighs over both consumers and businesses.
Yeah, and basically de minimis, we love a Latin word, especially on a Wednesday morning, is the fact that if you basically buy a good that's less than $800 for the moment, you're not taxed. We have a great viewer question. Grace, for you, basically, this person's writing in and says, do you think China was a heavy seller in Treasuries long end yesterday?
I think it's possible. I don't know definitively, but when we think about, sort of where central banks have been allocating to, we've certainly seen an element of their dollar exposure come down, and a lot of that has gone into gold. The EM central banks in particular, but central banks at large, have indicated in various surveys and in their flows over the last 12 months that they plan to allocate more to gold. That's what's pushing the price up. I mean, our price target for gold is 3,500 because we very much think, the demand is there, and obviously this is a commodity where supply is limited, and therefore we think this is a very strong geopolitical hedge.
Brendan, I know there's a number of press conferences, there's a number, of state visits, or at least visits from White House administration. Is there a couple of points that you're watching out for today and tomorrow?
Yeah, I think, look, we shouldn't forget the fact that some countries are coming to the negotiating table, as President Trump has indicated, Japan, Korea, India. So these are big export economies, and so we shouldn't underestimate the ability of the administration to secure some better trade deals. But in the meantime, the question is, for every job they say that they can create with those better deals, how many do they destroy in the process? A lot of companies would say that they're going to be hurt by these tariffs as opposed to protected by them.
Okay, thank you both for joining us. Grace Peters there from JP Morgan Private Bank and Bloomberg's Brendan Murray. Now, coming up, oil sinks to a 4-year low. We'll be discussing the implications of that with Amrita, founder of Energy Aspects. This is Bloomberg. European stock markets resuming their sell-off this morning as President Donald Trump's sweeping new tariffs came into effect. Now let's bring in Bloomberg's Michael Msika, Deputy Team Leader for EMA Equity Markets and Strategy. Michael, I can ask you a million questions because the market is just volatile and very stressed. And so that sometimes does these odd moves where they're up a second but down. What are the industry groups that are reeling the most?
The markets is very volatile. The reason is the liquidity is really poor at the minute. So you will have a lot of those moves, rip higher, some dip lower. It's a very complicated market to trade. In terms of groups, industry groups, because that's what I wanted to mention. It's funny, those sectors that were defensive in the past are not really defensive anymore. We talked about pharma this morning in taking stock. This is the reality we live in. Every single group that is targeted by the Trump administration will suffer, whether they are a defensive sector or not. And that's what we are witnessing right now.
What about consumers?
So that's down the line. The problem with consumer is how much the consumer is going to be hit by the tariff, how much the inflation is going to shoot up, how much the job market is going to be affected by those tariffs. And when those consequences really hit the market, then we will see a drop in consumer, a drop in consumption generally in the US and in the rest of the world. But that's down the line.
We'll also be speaking to Amrita in a second on energy, on oil, but we also look at miners. I guess how much damage will the tariffs do to global demand and therefore some of these companies?
So that's the main problem for those groups. So you see already today a big drop in oil prices. This is a repricing of global growth, generally speaking. So demand for oil, for commodities generally, is expected to drop if those tariffs stay in effect. So again, it's all a bit of a if, because at the moment, it's like we are pricing the worst case scenario. Tariffs are in. It's 100% on Chinese goods. The growth is going to drop. But of course, if we get negotiations in the next few months, if we get trade deals, that will change.
What is the one thing that you're looking out for? Again, we look at this, stress a little bit everywhere, and there's genuine questions about whether the plumbing breaks because you don't really know where stress or risk goes to. I know Bloomberg is on high alert with all of our reporting team, but is there anything in Europe that we should be watching out for?
So really, what we see in the market is how much asset managers are willing to de-risk at the moment. Yeah. This is the key. I was reading some notes from Goldman Sachs partner earlier about the S&P 500 especially. We are now at a level where long-term investors are willing to step in. They're not going to step in straight away at that level. They will scale it down and slowly getting in. But we are at that level where the drawdown that we had in equity markets is getting attention from long-only investors, for sure.
And that's very diplomatically put, getting attention. Everything is getting attention today. Michael Msika, thank you so much for joining us. Bloomberg's EMEA Equity Markets and Strategy Deputy Team Leader. Now, oil sinking to a 4-year low as intensifying global trade wars threaten to batter energy demand. Brent tumbling towards $60 a barrel. WTI falling for a 5th straight day as a fresh wave of U.S. levies went into effect. Now, for more on the energy space, let's bring in Amrita, founder and director of research of Energy Aspects. Amrita, thank you so much for joining us. How much damage do you think these tariffs will do to oil demand?
Well, I think, look, we believe if the tariffs stay as they are, without any negotiations and without accounting for either the currency moves or even domestic stimulus, because I'm sure a lot of countries will go ahead and stimulate, then the demand loss in oil could be over 1 million barrels per day. In some cases, like you could argue that's almost the worst case scenario, but that's obviously not going to pan out in reality. It will be less than that, given, again, China will stimulate, for instance, but it is still going to be significant. We are putting through about 500,000 barrels per day of cuts for our second half of the year, demand numbers already, particularly focused on the petrochemical side, LPG, ethane, because that's where the tariff war is going to be at its worst between China and the US when it comes to energy. And then fuel oil and diesel takes a bit of a hit. Gasoline less so, because again, it will take time to see how the consumer reacts and how deeply it actually affects them. It's much more an industrial recession first.
Yeah. So, Amrita, what do you think is the real reason behind the Saudis actually pushing OPEC Plus to raise supplies?
It's been about undercompliance by some of the laggards, and they have been, His Royal Highness Prince Abdulaziz has been kind of highlighting this for a while, right? He's been very patient over the last, I'd say a year, and he has multiple times stated that the cuts need to be equitable. They haven't been, and I think in the last couple of months, particularly with Kazakhstan's production, not just 150,000 barrels per day higher, they're like 400, 500,000 barrels per day more than what they need to be, forget the compensation cuts. I think that's where the change really came about. The first warning was when they started to unwind for April. And again, this is a warning shot. This is not a price war. A price war would entail millions of barrels per day coming back from spare capacity. This is a warning shot to say, get in line. If not, I do think you could continue to see another round of faster than expected increases, especially because when we spoke to the Kazakhs yesterday, they're saying they haven't even reached an agreement with their energy companies to figure out a way to cut production. So I think even in May, you could get a decision by OPEC that accelerates cuts further.
Yeah, so Amrita, so you don't see this as the beginnings of a new OPEC Plus price war?
No, because the price war would be significantly larger, right? Remember 2020, we had Saudis going to, over 12 million barrels per day, Russia kind of doing the same thing. This is very much saying, listen, we need to get in line. Everybody needs to contribute. And again, the 400,000 barrels per day of increases that are in theory coming in May can be offset by compensation cuts. So the net impact on balances should be zero as long as the laggards comply. So this is to put pressure on them to say, get your act together and comply. If it's about throwing the towel in, then, why increase by 400,000, right?
So, Amrita, where do you see prices go from here? JP Morgan, Citi are talking about $60.
Well, I mean, we've been saying prices can absolutely trade with a 5 handle, potentially even a 4 handle. Francine, my worry with this market is that we actually haven't priced in the worst. I think oil has. If you look at deferred spreads, they are in contango. But the wider equity market, we continue to see rallies on even a random statement saying there's negotiations. So I really, really do believe the market doesn't want to believe that these tariffs could be here. We believe they will be here at a higher level than the market as a whole believes. So if that's the case and there's risk-off sentiment, there's margin calls, what's stopping oil from trading with a 4 handle? Doesn't mean we stabilize there. U.S. production will react. We are already starting to see, producers kind of pull back at these price levels. But that rebalancing is going to take a couple of months.
So what will these prices do to shale oil and other supplies that are non-OPEC?
The biggest impact is going to be from shale. I mean, at these kind of price levels, if it lasts a quarter, we are looking at a few 100,000 barrels per day of outright declines because nobody's going to reinvest. And we have to remember Permian's got the best break-evens for the rest of the U.S. It's $10 higher. I was just there last week in the shale patch, and producers are saying to me that because it's gotten so gassier, remember steel costs have gone up for them 15%, so their margins have gotten poorer as well. You're talking about mid-60s plus for the rest of the U.S. as break-evens. And that is basically saying we are already well below break-evens, and you're going to start to see production being curtailed and actually decline just for 1 quarter of these kind of price levels.
Amrita, thanks so much. Amrita Sender, founder and director of research at Energy Aspects. Coming up, Elon Musk calls Donald Trump's trade advisor, Peter Navarro, a, quote, moron, as their White House feud turns ugly. We get the view from Bruen of Public Affairs Agency Global Situation Room next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, the market sell-off resumes in Europe as higher U.S. tariffs kick in, including 104% on China, but there's no immediate retaliation from Beijing. The Spanish Prime Minister calls for the EU to review its relationship with China in light of the trade war. He's set to meet the Chinese president on Friday. Plus, yields on 30- and 10-year Treasuries soar, threatening the asset status as a haven. Now, former Treasury Secretary Lawrence Summers has warned that the U.S. is now likely heading towards a recession, potentially putting 2 million Americans out of work thanks to Donald Trump's tariffs. Now, in an interview with David Weston, Summers also spoke about his outlook for the markets.
I think this is fundamentally a improvisational effort. You could tell that when you knew that there was a policy based on tariff reciprocity that didn't use any data on the tariffs of other countries in figuring out how to reciprocate. You could tell that from the blatant contradictions between what presidential advisor Navarro was saying and presidential advisor Treasury Secretary Scott Bessent was saying. You could tell that from the degree of division between close outside advisor Elon Musk and many members of the president's economic team. This is a policy, it's a hugely consequential policy, but by all appearances, it's being improvised on a daily basis, and that's creating huge uncertainty. But it's only uncertain. There's only uncertainty if things go in both directions. And today happened to be a day when things moved in a positive direction. I hope that the moves to back off these policies can continue, but we'll have to see. I suspect we're going to have volatile markets for some time to come, and no one can know, but my judgment is that I'd be surprised if the bottom is yet in with respect to this phase and markets.
How bad could it get?
Oh, I think the likelihood, I think it's more likely than not that we're going to have a recession. And in the context of a recession, we'll see an extra 2 million people be unemployed. We'll see losses in household income that are $5,000 a family or more. We're very likely, in the context of a recession, to see markets reach levels significantly below their current levels. So I think we could be looking for fairly serious economic problems.
Former Treasury Secretary Larry Summers there speaking to David Weston. Now, tensions over President Trump's tariff policy have definitely spilled into the open hours before the levies went into effect today, with Elon Musk hurling insults at White House trade counselor Peter Navarro. Now, Bloomberg's Charlie Wells is here with the latest. Charlie, I mean, this feels like a pretty big spat. I mean, does it reveal a clash of personalities, or is it deeper, just like a complete clash of visions?
Francine, I mean, on the face of it, these insults are certainly ad hominem, and they're relatively childish, speaking very broadly. But what they really do indicate is that the transformation of the Republican Party from one of free trade to one of protectionism is not necessarily done, and that transformation is not necessarily going to be easy. So you just saw these visceral comments coming from Elon Musk. You saw Peter Navarro lobbing them back. And you also saw the White House, though, try to downplay some of these divisions between counselors and advisors to President Donald Trump. But yesterday, you also saw tensions within the Republican Party in the Senate. So Jamieson Greer, the U.S. Trade Representative, was testifying before the Senate Finance Committee, and he got some very, again, visceral questions coming from Republicans, most notably Senator Tom Tillis of North Carolina, who asked, quote, "Whose throat do I get to choke," end quote, if this goes wrong? That was really kind of amplifying and indicating concerns even within Republican ranks about what tariffs could do to prices for consumers and what could happen in the midterms, which again are only 18 months away and seeming to cause some consternation even among members of the Republican Party.
Charlie, thank you so much. Of course, a terrific update from our Charlie Wells. Now let's continue the conversation on the divisions emerging within the Trump administration. We're joined by Bruen, President and Chief Executive of Public Affairs Agency Global Situation Room, former Director of Global Engagement in the Obama administration, and an ex-U.S. diplomat, and our very own Stephanie Baker, Bloomberg senior writer and author of Punishing Putin. So thank you both for joining us. First of all, Stephanie, and we were all, frankly, led to believe that Donald Trump was a businessman, that he wanted a deal, that he would put America business first, and that also he cared about the stock market. I mean, is this a timeline problem, that he cares about America but in 4 or 5 years, or is it that his North Star is something else?
Well, you see him governing on a far more radical agenda than he campaigned on. And I think that has shocked many of his supporters. You've seen, with some of his, donors like Ken Griffin, Bill Ackman, come out and criticize the tariff policies, which have gone much further than what he said he was going to do. I view the Musk attack on Peter Navarro as an attempt to get him fired. And I would say, actually, if I was to put my money on it, I'd back Musk, because Musk is far more important to Trump than Navarro is. All these his money, Musk's money, is the thing that Trump needs to control the Republican Party. A lot of Republicans are up for re-election next year, and the threat of being primaried with a Musk-backed candidate, if they don't fall in line, is the thing keeping them supporting Trump. And that if that's not there, there is a possibility that Republicans will look at the situation, will look at the economic fallout, the loss of jobs, companies going bankrupt if this continues, and decide to band together and form a veto-proof majority in Congress to block the tariffs from going ahead. When that will happen is unclear, but Trump has been talking about tariffs for decades, but no one, even his supporters, thought he would go this far, this fast, and that, no one denies that there's a trade imbalance with China, but even his supporters say that this shock and awe approach is not the way to do it.
Yeah, and Brett, I guess the question is, I've read so much on different theories about, Donald Trump wants all the countries to come and kiss the ring to try and get forgiveness or renegotiate. I've heard actually he really believes that this will be better off for U.S. companies longer term. Do we still need to think about why he's doing this to find a way forward?
I think the question of what is the end game looms large over Washington right now, because we don't have a timeline. Quite frankly, we don't even have a real strategy. We don't know, is this, as Peter Navarro would like, a restructuring of the U.S. and indeed the global economic order, or is it, as we're hearing from Trump, this is all about negotiation, this is all about leverage. And, what's interesting in this battle between Navarro and Musk is that Musk has not just money, but he has influence over large swaths of the party as it's currently constructed. Navarro does not. And so I do think as this, public spat plays out, Caroline Leavitt, the White House press spokesperson, said, well, this is just boys being boys. What's unusual is you don't usually see that play out in the West Wing. Right. That's something, that plays out on the streets of Washington, not inside the White House.
Yeah, but Stephanie, I remember interviewing Peter Navarro the first time around, right, when Trump was in charge. And at the time, even his thoughts on China were seen as outlandish. And then they became mainstream policy because a lot of his thoughts on China at the time were also then taken on board by the Biden administration. So it feels like he's not that easily replaceable.
I think he is. And, I follow the journalist motto, follow the money. I think too many people have lost too much money with this, that it cannot continue. Unpredictable as to when, this might be reversed. But look at Elon Musk. He's lost more than $140 billion. That is an enormous amount of money. And I think others as well, will put huge amount of pressure on Congress to stop this. The overall strategy, a lot of people do agree with, that there needs to be a rebalancing of trade. But the tactics that are being employed, as Brett has alluded to, there's no clear communication strategy. There's no clear goal set out as to what countries can do to get relief from the Trump tariffs. And it's not clear, is it a negotiating strategy? Is it a revenue-raising strategy? Is this about restructuring the American economy? If that's true, I don't think this is going to work. The input costs as a result of these tariffs are going to impact a lot of companies manufacturing inside the United States. I liken this to when the G7 put unprecedented sanctions on Russia as a result of Putin's invasion of Ukraine in 2022. Trump has essentially self-sanctioned the U.S. economy in an unprecedented way that will isolate it globally.
But what I still find surprising is that not a lot of people are coming out and talking against Donald Trump, right, despite the market rout.
Well, I think you saw the beginnings of that. Earlier this week, it was Senator Ted Cruz suggesting that Congress needs to take back some of the power of the tariff. Now you've got Tom Tillis, the Republican senator from North Carolina, as well as a whole host of Trump supporters, the billionaires who backed him in his campaign. And I think that will continue to increase in calling on Trump to rethink this, to take a deal, any deal. And what's interesting here is what we're seeing play out on the crisis front with Ukraine, Gaza, and now Iran is similar in some ways to what Trump's strategy is on these tariffs, which is, come to me with a deal, let me get a deal, any deal. And I bet, and I'm putting my money on this, that the White House is going to parade out this morning, look, we've got the beginnings, the concepts of a plan of deals with these countries to assuage concerns in the markets and to try to tamp down some of that Republican unrest.
So he just needs an off-ramp in an elegant way.
And the thing about Trump is it doesn't even need to be a fully fledged plan. What he will do is have a call with Keir Starmer here in the UK. He'll say, look, Keir is willing to give me the following concessions, even if he's only alluded to those. And then the White House parades that as the world is coming to Washington and offering Trump these concessions. That, I think, will be the turning point. We'll wait and see what we get from the White House this morning. But my bet is that they're going to try to push out some positive news to indicate the world is willing to concede.
Yeah, because, Stephanie, not much is actually going the president's way so far, right? He was expecting a quick resolution in Ukraine. That's not happening. I was also surprised that the tariffs touched allies. Like, if you look at Israel, if you look at India, no one got a better or softer deal because they were close to the U.S.
Exactly. I think a lot of people thought there would definitely be tariffs against China, but going against allies and so many other countries all at once was not anything in anyone's playbook. I think the big problem is that while there might be certain countries like Japan and South Korea that could do a deal, China does not seem interested in doing a deal. And the tariffs are so high that it's unclear what they could do to get any kind of tariff relief. And that slice of the pie is so enormous. even setting that aside, let's say there's some deals with South Korea and Japan and a few other countries. I think the uncertainty that has been unleashed by this is going to be so damaging for so long, that will be really hard to undo.
Yeah, could there, I mean, again, we're spending quite a lot of time looking at Treasuries and why what's happening in Treasuries. Is there a risk that China says, even if we can't retaliate on tariffs, let's just stop buying Treasuries and let's, do stuff with the reserves? Is there a longer-term play that the U.S. really won't have that U.S. exceptionalism anymore?
Well, that is their leverage, right? They could just pull out of U.S. Treasuries. The degree to which they're able to do that remains unclear, and maybe that is some of the reason behind the market moves. But that is definitely the weakness.
But could I also just lay out a smart play here, and that is if Trump is able to cut deals with Europe, with Japan, South Korea, some of those other big economies, and then tell them, on top of that, we want you to impose additional tariffs on Beijing. Now, all of a sudden, he's able to leverage. This is some three-dimensional chess, which, again, we'll see whether or not this White House is capable of doing that. But Trump has said everything's on the table. And the mistake he made in putting in place these high tariffs on everyone is that you're not able to apply the same pressure on China.
The problem is one of trust, right? As Stephanie knows very well, is that if you're an ally of the U.S., you suddenly go back into bed with them and say, yeah, everything's fine, let's go after China. Which brings us to your risk report. So you have a risk report out next week. I know you're looking at AI, ties with Elon Musk. Market meltdown is probably in there as well.
It is. And what's really interesting, over 100 preeminent public affairs leaders contributed to the report, which is now coming out quarterly. And the top risk is AI adoption. And what I think we're seeing is that companies are rushing too quickly to put in place some of these new AI applications without assessing the concern that that's raising amongst consumers and other stakeholders. That really is something that executives have got to be more careful in terms of how they proceed, because, yes, there are efficiencies to be gained, but there are also customers to be lost.
Thank you both for joining us. Bruen, Global Situation Room President and Chief Executive, and Stephanie Baker, Bloomberg Senior Writer and author of Punishing Putin. I think we have the book cover. If we don't, you should read it. It's a great read. Coming up, we'll be discussing China's next move in the trade war with the U.S. with Keyu from the LSE. Stay tuned for that conversation. It's up next, and this is Bloomberg. Welcome back, everyone, and let's get the European reaction to President Trump's new tariffs with a 20% levy now in force against the EU. Well, Bloomberg's Oliver Crook joins us from Brussels. So, Ollie, how is the EU reacting to this?
Yeah, Francine, we should probably take a second to mark the moment here, because we're talking about more than 500 billion euros worth of exports from the EU that go into the United States, the biggest exporter to the United States, now having a 20% tariff on all of those goods. That comes out to about 100 billion euros worth of different costs. And who is going to bear those costs? That is what we're going to begin to find out over the next few hours. Is it going to be the producers here in Europe? Is it going to be the consumers there over in the United States? It will probably be a bit of both. The next step for the Europeans here, the policymakers here, is they're going to vote a little bit later this afternoon on retaliatory tariffs to be imposed on the United States on certain goods. This, Francine, is in retaliation not to the 20% we got today, but the steel and aluminum tariffs that we got a couple of weeks ago. This is going to be a pretty muted response. It's only going to be about $20 billion worth of $20 billion worth of goods that will come into effect next week, and they may not even begin collecting those tariffs until May, because what they want to do is to create as much roadway to have negotiations with the Trump administration, an administration that so far has had no interest in speaking to the Europeans. Could that change next week when Giorgia Meloni heads over to the White House? She'll be there into talking to Donald Trump to try to get some concessions, try to advance talks on negotiations with tariffs. But we should also say, Francine, there's another geopolitical development we should be paying attention to, and that is that the Spanish Prime Minister, Pedro Sanchez, is heading to Beijing on Friday. He has for a very long time advocating a closer relationship with China. Could this shift in geopolitics, diplomacy, and trade put the Europeans going a little bit closer to China? We should say that all the trade ministers that I spoke to earlier this week are not yet ready to talk about a wholesale sort of rethink of the Chinese relationship. But in a world when the unthinkable seems to be happening every other week, it's a conversation we need to be paying attention to.
Well, We certainly do. Ollie, thanks so much. Oliver Crook there in Brussels. Now, China has held off from an immediate reaction to higher import duties imposed by the U.S. Chinese goods heading to the U.S. now face tariffs of 104%. Now, instead, Chinese state media have reported on the importance of building relationships with neighboring countries. Well, joining us now is Keyu, an associate professor of economics at the London School of Economics. Keyu, as always, thank you so much for joining us. Is China holding back? Are they looking at options, or do they want to try and find a solution?
Of course, China would like to find a solution, but there needs to be an appropriate off-ramp. I think China's waiting and seeing, but really, it really needs to be in a position of strength when they talk to President Trump. They are coming out with equivalent pressures, countermeasures, and really shifting from passive defense strategy to targeted retaliation. Just from the phase one experience, by pressuring U.S. soybean farmers, they have eventually come to an agreement.
I mean, is there anything that, for example, PBOC can do to actually try and shield from tariffs, or at least have some sort of tariff defense without aggravating the Trump administration too much?
Well, of course, the obvious thing to do is just massive amount of domestic stimulus. They've talked about targeting the specific industries that will be hurt most from the exports, and there'll be a lot more pivoting to new markets. Of course, that's more in the longer term, but in the short term, they are really eager to have a renegotiation with Trump. But again, China's really not the other small economies and be able to concede, because they believe that one concession leads to other more demands.
How are Chinese companies actually reacting to this, Keyu?
Well, first of all, it's been a long march since Trump 1.0. It has really set off a globalization frenzy of diversification of suppliers, factories, investors, new markets. It's been an ongoing process. If you look at the surveys now, 70 to 80% of Chinese companies have an ongoing overseas plan. So they are better protected than the first time around. Of course, in the short term, this is a massive profit squeeze for Chinese companies, but for U.S. companies as well. And part of the plan to raise tariffs on the U.S. goods is to actually shift some of the cost from the importers in China to the U.S. importers as well, to share the burden.
I mean, how much, given all of the changes in supply chains the first time around President Trump was in charge, how much more can China actually build some supply chains that are de-Americanized, or even, get away from dollar as a reserve currency and treasuries?
That's, again, an ongoing process, and this time around, it's just simply accelerating that, and you feel that undercurrent in play everywhere around the world, where you see everyone is trying to sign up new trade partners, including RCEP, closer with the partners, even talking about zero tariffs in 54 different sectors. We heard also from the previous panel, but I totally agree, feels a little bit warmer towards China, where we stand in Europe. And of course, there will be much more regionalization. China's talking to Japan, to South Korea. Again, U.S. is forcing these countries together. And these fixed alliances based on geopolitical and ideological interests, that is out, right? It's now a very fluid, realistic, circumstantial situation.
We know the Spanish Prime Minister, Keyu, is of course visiting China, and he wants the EU to pivot more towards China to counter some of these tariffs from the Trump administration. Could China actually longer term be a beacon of stability, and could China be the real winner in all of this?
Where Washington, D.C. is erecting greater walls, China is actually voluntarily lowering tariffs, even speaking about zero tariffs to the least developing countries. And it aims to build stronger alliances with Europe, Africa, Latin America, and ASEAN, and everywhere around the world. You see a lot more interest, even in Latin America, towards China. Of course, Europe and China have a lot to cooperate on, especially the EV and battery supply chain. And here, I really think that China is going to reevaluate its position in the globalization. In fact, taking measures to invest more in Europe, build joint ventures with European countries. As long as it's an open possibility, China will embrace this opportunity, including in finance, global finance.
In the shorter term, Keyu, what's the biggest risk for China? I guess that if you look at the yuan, that it could crash, or there's some very big shock of financial instability.
certainly, if the U.S. stock market experiences greater volatility, it will transmit to domestic stock markets and pull down confidence even more. China has already been very, very fragile, very vulnerable to confidence shocks, and this is certainly very bad news in the short term. Lots of companies are going to be squeezed of greater profits, but still, the Trump shock will be the most kind of convincing force for government to stimulate aggressively, to subsidize even more strategically, to pivot to new markets. And China is now readily in survival mode.
May 2nd is also a big day because for now, a package that's shipped directly to the U.S. consumer that has a retail value of no higher than $800 basically doesn't get tariffs because it's too small to matter. But that changes for packages coming in from mainland China and Hong Kong. Will that be a big hit to the Chinese economy, Keyu?
Well, actually, right now, China is really trying to accelerate some of the service trade, the digital e-commerce to offset some of this of tariffs. So we're going to see more of that. In fact, we have to be reminded that the U.S. has a trade surplus in services with China in finance and all these things. And this could be another target for China in terms of countervailing measures. The negotiation could look like opening the financial services more to American companies, which I think is a great thing. But what this is all doing is to shift, to really restructure a global supply chain. I mean, costs are going from 15% to 45%. And so we're embracing new technologies.
Yeah, Keyu, as always, thank you so much for joining us. Keyu Jinder, Associate Professor of Economics at the London School of Economics. Don't miss our Markets Daily newsletter for what's happening in stocks, bonds, and currencies. This is Bloomberg.